Hi, this is James Stanley with Daily Effects Education. We want to thank you for attending our presentation on trading with candles, also called price action trading. We're going to first start by taking a look at a couple of risk disclaimers, and then we're going to delve right into the topic of contents. So please do review these following disclaimers, and we'll meet again here in a moment. Candlestick trading is extremely widespread and very popular, so we have a lot to cover today. We're going to first start by going into an introduction to price action. We're then going to take a look at candlestick analysis and what one individual candle can tell us about market behaviors. We're then going to take a look at price swings, the ways that traders can identify support and resistance, and use this in the management and initiation of trades. We're then going to move on to grading trends and look at a very unique way of identifying trends with only price and price alone. We're then going to take that a step further to see how we could trade with these price swings, and then we're going to get in depth behind the concept of candlestick patterns. We're going to take this a step further by looking at reversal patterns and continuation patterns. Price action trading is the art of analysis and decision making with only price and price alone. Now, as you see here on a chart, this is where a trader has used only price to decide when they wanted to buy and sell. And this is very possible with candlestick trading, and this is what we're going to look at today. When analyzing price action, traders are going to use price and the formation of candlesticks to analyze charts. Traders can look to previous swings or inflection points in the market to identify potential support or resistance levels they may want to utilize for managing risk or entering trades. Traders can look to grade trends based on a series of higher highs and higher lows in the case of an uptrend, or lower lows and lower highs in the case of a downtrend. And once they've found a trend that they feel comfortable with, they can look to enter trades based on patterns. There are single bar patterns and multiple bar patterns, both of which we'll go over today. We're going to go over that a little bit later. One single candle, often called a bar, can tell us quite a bit about what's going on in a given market. And that's what we're going to look at here. We're going to take a look at two individual candlesticks to see what we might be able to glean as a trader and what kind of information we might be able to derive off just that price alone. Here we have a red candlestick, and this candlestick is red because the close price was lower than the open price, meaning that the price went down over the duration of this candle. But notice, there's quite a bit more information that's available to us here. We can see the high price for the period, the opening price for the period, the closing price for the period, and the low price of the period. The candle body, or the thick part, is going to show us the range between the open and closed prices, while the wicks, or the smaller parts, are going to show us where price had moved, but not opened or closed at these levels. And here we have a blue candlestick. And this candlestick is blue because the open price was lower than the closing price, i.e., price had went up. So we have red candlesticks and blue candlesticks, and the color is going to be determined by the difference between the open and the closing price. Once again, notice quite a bit of information is available to us from just this one candlestick. For instance, we can see the high price of the period, closing price, opening price, and the low price of the period. And now that we know what an individual candlestick can tell us, we can begin to notice market themes and events based on price and price alone. For example, take a look here, and you'll notice that we have a previously established level of resistance noted by the black line. Eventually, price is strong enough to break through this black line and continue even higher. So this tells us something. Something good must have happened here. And in this case, we can take a look at this chart and notice how price made a low point and then reversed very, very quickly. So we know that some type of big change took place here. We don't need to know the news or events. All that we need to do is read the simple price action that's available in front of us, and we can notice that something provocated this move. We can even take this a step further and see at what price we'd actually seen that reversal take place. And what you see here is where a candle had moved up very, very quickly in price, but during that same bar, price moved down very quickly. Notice the long wick that's exposed to the upper side of the candle? Well, that indicates that price had moved down very, very briskly while this candle was being formed. Traders can take notice of the price at which that reversal had taken place. And notice that we have the same chart as earlier, but now we've identified the swing high that price had ran to before eventually reversing. And we could, of course, take this a step further to identify multiple swing highs and swing lows that are being made in the marketplace. You'll notice from the picture in front of you, numerous swing highs and swing lows have been identified. Each swing low can be classified as an element of support, while each swing high can be classified as an element of resistance. We can take the swing highs and swing lows that are exhibiting themselves in the marketplace, and we can then begin to grade trends simply by analyzing candlesticks. Notice in this chart how the trader can observe that swing lows and swing highs are being made, although both are taking place at a higher price. And the fact that we have both taking place at a higher price, that tells the trader that he's in the process of witnessing an uptrend. And here's the exact opposite of that situation, where now we're looking at swing highs and swing lows being made at lower prices. And now this time, the trader's looking at a downtrend. And in this example, we can see where a downtrend turns into an uptrend. And once again, no indicators are needed to be able to classify or decide what direction this trend is going. Simply noticing the swing highs and swing lows in the marketplace can help the trader identify the nature of these trends. Now that we know how to identify trends and identify swing highs and lows, let's delve a little bit deeper in how to actually trade these price swings. When trading with price action, traders are going to want to employ the age-old mantra of buy low and sell high. In this particular case, notice that our trader had witnessed an uptrend, as indicated by the blue and red circles pointing out the higher highs and higher lows that have been made. After price goes on to make another higher low, indicated by the green circle, the trader can look to buy low at that price. And here, we can get a more granular look at this actual setup. And notice that our trader looks to initiate the trade after the higher swing low has been inset in the market. And of course, when trading with a downtrend, the trader wants to look to sell. And in this case, you can see on the chart the trader's identified a downtrend as noted by the consecutive lower lows and lower highs. In this case, the trader's goal is to sell at as high a price as possible and to buy back later at a lower price so that they can have a profit on the trade. And notice here, the trader's watching price get more expensive as indicated by the blue box. But yet, a new high has not been made, as indicated by the black line showing the previous high that had been inset by the market. And here we can get another look at the same setup, and notice as price begins tipping down, indicating that the high price that was set within the blue box is the actual swing high, the trader looks to initiate their short position. Once again, when it comes to price action trading, you want to look to buy low and sell high. The goal, of course, being to be a prudent trader and to not buy when price is too high or to sell when price is too low. Now that we know how to grade trends, identify price swings, and decide whether or not we want to buy or sell based on the prevailing trending condition, let's take a look at what traders consider to be candlestick patterns. And these can oftentimes be the entry trigger for the initiation of a trade. Here, we have one of the most popular candlestick patterns that are available on the chart, and that's the doji. The doji is an indecision candle. This is going to come about when traders are indecisive about where they want to take price. Notice the doji is highlighted by a very small and thin candle body, with an open price very close to the closing price. During the candle, price can run up and it can run down, but if the candle closes very close to where it had opened, then we have a doji. Dojis can be a very operative way for initiating a position. So, for instance, let's take this trader who's witnessed an uptrend. He notices that price has recently come down. And on the next candle, the trader notices a doji that had formed, circled right here, and the trader decides to buy. Once again, we have an uptrend. The traders just recently saw price come down, indicating that a swing low may be in the process of formulating, and then he notices a doji, or trader indecision, in the middle of this uptrend. After the trader had bought in this situation, notice that price continues higher. We can take the concept of candlestick patterns a step further in looking at reversal candlestick patterns. Once again, we want to reiterate the concept is to buy low and sell high, whether it be a reversal candlestick pattern or any other. Here we have the double top formation. Notice that this is highlighted by the fact that we've had two similar tops move up to the same price and reflect down. And here we have the exact opposite of that formation, called the double bottom. Once again, this is where price runs down to a similar level of support and makes a second test of that same level. The next formation is called a pin bar. And a pin bar is short for Pinocchio bar, meant to point out when traders may have been seeing a lie from the market. Notice that a pin bar is highlighted by a wick that's more than 2 times the size of the candle body. This wick should stick out from price action, much like Pinocchio's nose. Here, we can see how a pin bar had formed. Once again, notice that this wick is sticking out from price action and is more than 2 times the size of the candle body. Shortly thereafter, price had reversed very briskly, once again highlighting that the pin bar is a reversal candlestick pattern. On the opposing end of the spectrum from reversal candlestick patterns, we have continuation candlestick patterns. And these patterns differ in the fact that traders will often look for continuation of the momentum that had developed within that candle. Please note that these can be dangerous, and they can be looked at as chasing price. So caution and risk management is necessary when utilizing continuation candlestick patterns. One of the more popular continuation candlestick patterns is called the engulfing candle. And with an engulfing candle, we get a candle that will completely take out the previous high and low of the preceding candle. Engulfing candles can come in either a bearish or a bullish flavor, depending on the direction with which the candle had moved that engulfed the previous candle. Here we can see both. Notice on the left we have a bearish engulfing candle. This candle had went down, which is why it's bearish. But also notice that this candle's high and low had taken out the high and low of the previous candle, which is why the previous candle was engulfed by this current candle. On the right side, notice we have a bullish engulfing candle. Once again, notice the high and low of the previous candle was taken out, but notice this time, this candle went up. So this is a bullish engulfing pattern. And here, we can see a bullish engulfing candle that had popped up in the middle of an uptrend. Once again, this is a continuation pattern. So after this candle is formed, traders are going to want to look to buy in the direction of the trend and in the direction of the engulfing candle. In this case, notice that price continues to rise after we have the large candle that engulfed the high and low of the previous candle. And here, we have a bearish engulfing pattern. Notice price had been going down, accented by the lower lows and lower highs that the market had been making, and then when we get our bearish engulfing pattern entirely taking out the high and low of the previous candle, traders sell, looking to ride the momentum that had developed during that candle. Now that we know some of the more popular candlestick patterns, let's take a bird's eye view of everything that we've learned today to see how everything fits together. First and foremost, a lot can be analyzed from one single candlestick, but multiple candlesticks can tell us even more. Price swings could point out potential support and resistance levels, and we could also look to grade trends with those swings. Of course, anytime we're trading with price action, we want to look to buy low and sell high. And this led directly into candlestick patterns, in which we looked at both reversal and continuation patterns. And this brings us to the conclusion of our candlesticks presentation. If you have any questions, concerns, comments, feedback, or anything else at all that we may be able to assist with, please don't hesitate to reach out to us at instructor@dailyfx.com. I want to thank you very much for your time, and we want to wish you happy trading.